We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Justin Huhn, founder and publisher of the Uranium Insider newsletter. How are you today, Justin?
Doing pretty well. Kind of nursing a injury in my back that's very minor, but it happens a couple times a year. But besides that, I'm doing great. Yeah.
Well, hopefully you're on the mend soon here, Justin.
I hope so too.
But we've got a lot to distract you from the pain of your back today.
Great.
It seems like we're at a real inflection point here. You just came off of hosting a public webinar last week, and you felt that was important to give to the public because of this inflection point that you feel within the industry. So I want to kind of there's so much to talk about here that I want to start by kind of separating it out. So if we could, why don't we start talking about the miners and how they're continuing to trade at relatively low valuations in compared to the metal. Last week I spoke with a gold analyst, and he was saying that this condition is present in the gold miners as well. And it's more so due to the margin compression because of the higher input costs, despite being within, $100 an ounce from the all-time high in gold. So is this part of the same challenge that's being faced within the uranium industry right now?
To some extent, yes, but I would say largely no, because there's just not that many companies that are actually producing anything. So the fact that the rising costs of inflation and inputs, whether that be supply chains, larger costs for labor, and of course, oil, diesel inputs, all of these things raise the overall cost of development and production. The number of companies that are actually producing are so minimal that I don't think that's really having an effect necessarily on the performance of the equities that are linked to these companies. The uranium equities are kind of in a world of their own, although they tend to be coupled with various things when they're not moving on their own accord. So if there's not a lot of flows coming into the space, which is the case right now, they tend to be coupled either with the broader market or sometimes with just energy in general. So last week we had one day where oil was down a few dollars on a single day, and the US dollar was slightly up on the day, and pretty much everything across the board in the energy and metal space got sold, and uranium was lumped with that, for example. But honestly, right now, the equities are reminding me a lot of this period of time, which was June, July, August of 2021. And so this came after there was a pop in like March, April, May of that year. A lot of that pop came from the news that Sprott was taking over Uranium Participation Corporation. Mm-hmm. And as the months went by, it became kind of a buy the rumor, sell the news sort of thing, where we knew that Sprott was coming. We knew that they were going to have an ATM. We understood how the vehicle would work. We knew the date that the ATM would go live, which was late August. Don't remember I think it was August 21st, doesn't really matter. But the months leading up to that date, the equities continued to sell off. And I think about this period of time a lot because there were a number of people throwing in the towel at that particular time. And there were even some of those people were reaching out to me saying that had been, there was one person in particular who remained anonymous, but I think about him a lot because he had initially positioned in the earlier part of the year, was sitting on some decent gains a few months into the year, started to buy, added to his positions a bit higher, to his positions a bit higher. And then we saw from June to mid-August, we saw a 35% pullback, something like that, big pullback in a short period of time. Mm-hmm. And he was like, I just sold for a major loss. This has been the most difficult experience of my entire life. I can't take this anymore. And that was about 2 weeks before Sprott's ATM went live. And the following 3 months, September, October, November of 2021, equities doubled and tripled in the course of 3 months. And this period of time reminds me a lot of that, because there's very similar types of events that are happening right now. So for example, we've got multiple physical funds kind of on the horizon, one in the near term. We've got that's the Zuri Invest physical fund that's being set up in Switzerland. It's a different vehicle. This vehicle will not be publicly traded, but you can buy and sell it through a brokerage with an ISIN number. You can, the minimum lot for them to purchase is 100,000 pounds. And when they go in and purchase uranium, it's, first of all, it's not going to be as transparent by any means as Sprott is. So they're not going to be signaling when they're raising money. They're not going to be signaling when they're buying uranium. They don't want to be front run in the market. And so they're going to go in and buy uranium front month settlement only. So that's within 30-day settlement. And if they go in, so their initial raise, they're shooting for 50 to 100 million. We have no idea how that raise is going, because they are not telling anybody, us included. They don't want the market to be front run. But let's just say they raise 100 million, they can go in for 2 million pounds, or almost 2 million pounds at this point. If they go in for that and that's not available at $53 a pound, they don't go out on the curve to get filled at that price. They raise their bid. And so we could see some very real price discovery coming from this fund. In addition to that, while I can't confirm, we're hearing rumors about 2 additional funds that are being set up in other parts of the world. So one of those, we could hear news on that very, very soon. The other one is still quite pretty rumored. So, but either way, what we're seeing here is continued establishment of the financial sector's interest in having exposure to the pure play commodity, and knowing how tight the physical market is and how tight the spot market is. It's very likely we're going to see a situation where we have financial entities and these physical funds competing for pounds with utilities that are finally kind of getting the smoke signal here and showing up to the table. We're seeing huge long-term contracting volume right now. So that's very good to see. But yeah, the inflection point, it's been multiple years of working through above ground mobile inventory that was in abundance from the previous decade's oversupply. That took a long time, and we've had some fits and starts. We've had one good, really big first leg up from, that was December 2020 till about December 2021, about 12 months. Mm-hmm. We've had a couple of counter trend rallies in this longer term consolidation period that we've had since then. But gosh, I mean, the market, it's the term contracting cycle is happening. And you can actually look at the first 3 big years of term contracting volume from the previous bull market, 05, 06, 07. And you can see what happened to the spot price during those years. It absolutely went nuts.
Justin, maybe before we get to the idea of the term market, do you think that the Sprott Physical Trust inspired, others to set up these funds just to take physical pounds off the market?
That's not necessarily the gist that I'm getting from Zuri Invest in particular. I don't think their goal is necessarily to take pounds off the market. I think their goal is to provide a vehicle that will trade persistently at NAV. So there's benefits and downsides to both of these vehicles, right? So Sprott, for example, is highly liquid. You can enter a position or liquidate a position, in a very liquid market, in a single, just in a quick moment. Whereas this other vehicle, you have to go through brokerage to enter that position. And then when you exit that position, it could take up to, 30 plus days for settlement, depending on a number of market factors. So if the Zuri Invest fund is sitting on sufficient cash, which the only reason they would be is if they don't have enough cash on their balance sheet to actually purchase that minimum lot of 100,000 pounds, which would be $5.3 million right now. So if they've got 4 million in their coffers and you go to liquidate your position of 1 million, done, easy, right? They can also try to cross off that sell order with a buy order. And all of those other options aside, if there's insufficient cash or a buy order not able to cross off your sale, then they will actually sell uranium. to raise the cash to liquidate your position. Now, they don't expect that to be happening very much at the early stages of this market, but when we get to a point, probably multiple years down the road, that particular fund and probably some other funds will potentially be sellers in the market. So that's something to keep in mind. But I think that they saw an opportunity not only in European appetite for exposure to the commodity. Of course, there's also yellow cake in on the LSE and the London Stock Exchange, but yellow cake also has been trading at a persistent discount to NAV, and that was something that they saw as a problem. So others might see it as an opportunity. If you believe that the price is going higher for the spot price, and you believe that spot will again trade close to NAV, then buying uranium at a 7, 8, 9, 10% discount to NAV is sort of kind of some torque on that play. But again, if you bought close to NAV and the trust is still sitting on some cash and now they're trading at a 10% discount to NAV, you might not be all that happy with how that's being operated. So they were like, okay, if we do this vehicle so it's not publicly traded, we won't have those extremes in terms of discounts or necessarily premiums to NAV. We'll trade persistently at NAV. So investors can have a vehicle that's always trading in line with the commodity. B, the funds you put into that buy uranium, period, the end. And they do so front month. So if you want to see what sort of price discovery your investment can have, you know that every dollar you put into this vehicle is going to buy uranium. That's not the case with Sprott when they're trading at a discount to NAV. So only when they're at a premium to NAV will a certain percentage, 50, 60% of the daily volume on a day they're at a premium, that money goes towards share issuance on their ATM and then buying a physical uranium. So very different vehicles. Both, I think, serve different purposes, but that is in addition to yellow cake, $100 million a year from Kazatomprom. That's in addition to ANU Energy, which is being set up in Kazakhstan. They are now looking to raise a total of $500 million US. Their IPO is for the second quarter of next year, so we're a little ways away, but still they're getting set up. Then you have the Zuri vehicle. So we now have 4 established funds, essentially. Yellow Cake, Sprott, Zuri Invest, and ANU Energy. And then again, like I mentioned, there's a couple more that we're hearing about. Over the next year or two, we could potentially see 6, 7, 8 physical funds in a very thin physical market. So I think the chickens are coming home to roost relatively quickly here. And now seeing how active the utilities are in the market, it's setting up for quite the thing in the spot market.
As you're saying, how active the utilities are, that returns us to the point that I interrupted you from, the term market. So you were saying that, the last bull cycle, we saw some major activity in the first 3 years. So what effect did that have on the price back then?
That had a pretty significant effect on price. So we saw, I think it was 2005 was the first year where we saw really, really big contracting. And that led to a big jump in the spot price. I'm trying to bring up the chart here really quickly so I can tell you exactly how it moved. But the spot price absolutely followed the direction of the term volume. Okay, so it wasn't even necessarily a move in the term price, although it was. But the term volume is really what lit a fire under the spot market. Now, of course, at the time we had hedge funds buying physical uranium. We had UPC get established in 2005. So there were other factors moving the spot price of uranium. But so for 2005, we saw 250 million pounds contracted. At the time, what happened during that year, the spot price jumped from 60 to about $80 a pound. And then from there, that jump happened that first year. And then from 2005 to 2007, it essentially only went up. It didn't even ever tick down pretty much at all over a 2+ year period. It maybe spent a week or two going sideways here and there, but it only went up. So 2005 was that first big year. 2006 had 210 million pounds contracted. 2007, about 235 million pounds contracted. So 3 years in a row, well above replacement rate levels. And that ultimately is what really moved the spot price. I mean, in addition to the financial players, which obviously helped at the time, but we still had the interesting thing about that market was it was far more liquid than this market is now. Far more liquid. You still had some enrichment underfeeding secondary supply. Not as much as we saw towards the later part of the decade, of the last decade, where we saw maybe 25 million pounds a year of underfeeding. Wasn't quite that much back 2005, 2006. There was a little bit, but you also had megatons and megawatts until 2013, which was 20 million pounds a year of secondary supply coming from downblending nuclear warheads, and that was every year. So you had this buffer of secondary supply during that market, and you also didn't have a structural deficit, which we have right now. I have a very hard time believing that we're not going to see a similar or perhaps even more robust move in the price now due to all of these factors. So year to date, 99 million pounds signed in the long-term contracting market as about 20 weeks into the year. So a little more than a third of the year gone. If we continue that pace, we're pushing 275 million pounds for the year, which is a massive year. That would actually be the most pounds contracted in a single year, at least for the last 20 years. So that would be a big signal to the market. Typically, we see a slower period for utilities in the summertime. So perhaps we won't keep that pace, but if we do, that again is a big signal. And there's so many factors leading to the utilities finally showing up. And we covered a lot of this in the webinar that you mentioned, but it's not only the thinness of the spot market, it's the fact that carry trades are not really being put on right now because of interest rates and the thinness in the spot market. Those two reasons are keeping carry trade volumes very low. The fact that we're seeing the major reliable Western producers, primarily Cameco and Orano, but in this case, we're talking Cameco, sign very bulky contracts with Eastern European utilities that historically had been sourcing material from Russia. Now they're getting pounds from Cameco. And so the Western utilities are going, hey, this producer that we've relied on forever, which we still can't rely on going forward, but they don't have an unlimited capacity to produce. So I'll give you an example. The next 5 years, on average, they've got contractual obligations for the delivery of about 26 million pounds a year. How much do they produce with MacArthur and Cigar? 18 million pounds a year plus Inkai. 26.6 million pounds a year is Cameco's share. So that's for the next 5 years. So their book opens up a bit past that, and they're going to contract a little bit above their volume and get pounds where they can. But, Western production, and I should say, even if you include, Kazatomprom is kind of sitting in a tricky place geopolitically, but historically they have been and will continue to be, especially for Europe, Western suppliers and their JVs, of course, Orano, Cameco, and the Chinese and a couple of Japanese entities, in addition to the Russians. Some of those players will have pounds available to the West, but that's a small percentage of their overall production that really is going to end up westward. So this tier one production capacity, even going out 5, 6, 7, 8 years, is being consumed very rapidly. And what happens once that is consumed is you go back, then you go to tier two. Then you start looking at, the Namibian pounds coming from the Chinese, coming from Paladin, coming from potentially developers there. They need higher prices. The development projects in the United States and in Canada, in Niger, they're going to need a bit higher prices than Kazatomprom and Cameco and Orano. So we're just going to see these stair steps up in price as supply capacity in the future is increasingly consumed with progressive contracting by utilities, until we get to a point where the marginal cost of production, I did a podcast like 6 months ago, a Uranium Market Minute podcast, and I think I remember it. I titled it, the cost of the last pound determines the price. So if you're a utility and you're uncovered and you're looking to cover from 2028 to 2032, and Cameco's saying, hey, sorry, we're full. Kazatomprom is saying, sorry, we're full. Orano is saying, sorry, we're full. Then you go hit up some of these, development projects that are saying, all right, we're going to do market reference with the floor at $75. All right. And the ceiling at 110. That's what we're going to see 12 to 18 months from now. So I just don't see, lacking some event that drastically changes the demand picture. That could be a meltdown. That's always a risk. I don't know. But lacking some big hit to demand, I just don't see how we are at very, very heightened prices relatively soon here.
Mm-hmm. Justin, you kind of touched on this idea of the separation of the West versus East. On the show, we've spoken a great deal about moves with the BRICS plus nations and their cooperation, let's say in the currency and gold markets. How have the Russian sanctions affected uranium sourcing from that part of the world, and how has it really bifurcated this industry as well?
Well, we've yet to officially see sanctioning. So what we've seen so far has essentially been self-sanctioning by various entities, utilities primarily from the United States and the European Union. So what that essentially means is a number of these utilities have continued to rely on deliveries from Russia, from legacy contracts, but they have not entered and seemingly are not planning to enter into new contracts with Russia going forward. So the US is definitely less covered in terms of inventories than the EU. And some of these utilities pretty much need those deliveries of Russian EUP in order to operate their facilities next year and perhaps the year following. If that were to just be cut off, they would be in a pretty vulnerable position, let's say, in terms of fuel deliveries. So certain utilities in the United States have been pushing to the extent that they're able to for those deliveries to continue to be allowed. And it's a little bit tricky. There's one Canadian shipping line that will carry that class of material from Russia, and they were given exemption last year. I believe the vote on that exemption is coming up next month, if I recall correctly, to see if they'll extend it for an additional year. We're not really sure. There's plenty of talk in the United States about let's get enrichment going here. Let's establish a HALEU circuit. Let's support domestic LEU ASAP. Light enriched uranium or low enriched uranium, and plenty of talk about that. But these things always take way longer than they hope for. So really, what we're looking at is the bifurcation essentially has been voluntary. So while Kazatomprom and their joint venture partners have been attempting to avoid shipping through the port of St. Petersburg in Russia, and utilizing this Western route, it's just much more complicated. It's going through Azerbaijan. In order to avoid Ukraine and Russia, it has to go through Azerbaijan and Georgia and cross the Caspian and the Black Sea, if I recall correctly, potentially going through Turkey. It's a complicated route. They have shipped material successfully, but it's certainly not as easy as just putting it on a train and sending it to China. Mm-hmm. And more pounds coming from Kazakhstan are going to end up in the East. We're seeing further evidence of that ongoing. So a couple of weeks back, we saw the announcement of a very large possible contract with the Chinese, with the CNNC, with Kazatomprom. It's large enough that it requires an AGM and a shareholder vote to approve this contract. So based on the percentage of their overall book value, it looks like it's at least something like 33 million pounds and potentially up to 200 million pounds. So we're going to have to see how that contract goes. But already the Chinese are major joint venture partners in a number of deposits with Kazatomprom, and they buy a lot of material from Kazatomprom directly outside of those joint ventures. The more and more of these pounds are going to be consumed by China. And then just today, an article came out on Bloomberg where they're discussing that. So the Kazakh Sovereign Wealth Fund is a 75% owner of Kazatomprom. The other 25% is public. And so the Sovereign Wealth Fund apparently had pushed through a deal with Russia, with a Russian uranium entity. I don't recall if it's Uranium 1 or Rosatom, it doesn't really matter. That for the Budanovsky, this is a new, very large deposit that they're developing in the country. And they pushed through a deal for Russia to own 49% of that. And the resulting action of that deal being pushed through by the Sovereign Wealth Fund is that a number of C-suite managers, let's say, management at Kazatomprom ended up leaving the company. And just, this again, it's more pounds coming out of Kazakhstan that are going to remain in the East. So if Russia has 49% of that deposit and those Russian pounds are not going to the EU or the US or Canada, that's more pounds from the major producer not heading to the West. And it's important to remember 70% roughly of the world's nuclear reactors are in the quote unquote West. So the bulk of the demand for uranium and fuel cycle products and services exists in the West. So anytime more pounds likely are less likely to end up in the West, that creates more tightness for the utilities in the West. And that's exactly what we're seeing.
But, looking forward, Justin, is there not a huge demand coming out of China for reactors that they are building? Like, what are their targets for the next, let's say, 10 years on what their capacity for nuclear energy production is going to be?
So China famously has a lot of inventory, right? So they've got somewhere, estimates are between 300 to 400 million pounds of inventory, which is a lot. But if you consider the size of their existing fleet, which right now I think is 53 gigawatts, and their plans, so their plans last year, or I suppose the year before, were to hit 200 gigawatts by 2035. They were clearly not on pace to hit that. So even though they're growing their nuclear fleet faster than any other country, there's no way they were on pace to hit 200 gigawatts at 2035. That's another 150 reactors in 12 years. So they weren't seeing 13 construction starts a year. They were seeing 2 or 3 or 4, which is incredible, but still not on pace. They revised that down to 150 gigawatts by 2035 this year, but reiterated they are going to be doing everything they can to hit that target. So right now, let's see, I think they have 22 reactors under construction currently, and they're at 53 gigawatts now. They have, dozens in the planned and over 100 in the proposed. So they're going all out. And China does not have a lot of production in country of uranium. So they don't have a lot of uranium wealth in their geology, let's say. But they do have the Husab mine in Namibia. That's a pretty large production mine. Of course, it's been a development headache in the early years of development. They spent way more than they had planned and got much less production than they had planned. But it's still a big production. I think they get somewhere to the tune of 10 or 12 million pounds a year coming from Husab in Namibia. They have a stake in Paladin's Langer Heinrich. And then, of course, they've got JVs in Kazakhstan and more pounds coming from Kazakhstan. So despite sitting on that inventory, all signs are showing that they're seeking to increase the amount of uranium coming into the country. So that to me tells me that they plan to stick to their targets of hitting even 150 gigawatts by 2035. That's another 85, 90 reactors in the next 12 years. So that's a lot. That's 8 reactors a year. Huge amount, a huge build out by China for sure. Yeah.
This geopolitical picture kind of changing, especially, basically since the conflict in the Ukraine started, really has changed so many dynamics in let's say the globalization or the global cooperation of the world. Last month, the G7 nations recognized the importance of nuclear power by meeting and discussing how to displace Putin from the international nuclear energy market. So what was the development here, and what are the considerations that the G7 are facing?
It's hard to really tell what that means specifically, other than just kind of rhetoric. So I mean, it obviously has some significance, and it wasn't all of the countries of the G7. It was 5 countries, right? So it was Japan, the UK, the US, Canada, and France, if I recall correctly. But still, the collaboration is there. And historically speaking, collaborations when it comes to nuclear energy tends to involve more consideration than just cost or the technology of whatever reactor is being proposed to be built in whichever country, but more about political alignment. So, for example, Poland, by the way, is really going nuts on their nuclear plans. They have 0 reactors in the country right now. They have a ton of coal power. Next to Germany, they have the most carbon intensive grid. But they are planning on a lot of nuclear. They're looking at, I think it was 5 or possibly more AP1000 Westinghouse reactors. But my point being that they had the option of securing a deal with GE Hitachi, with the French, or with Westinghouse, and they chose Westinghouse probably because they'd like to solidify political alignments with the United States. That's the way these things work. So to have Japan, the US, Canada, France, and the UK all to come together and say, hey, we recognize the importance of nuclear. We want to collaborate on excluding Putin from the global stage when it comes to nuclear. I don't know how they plan on doing that because the BRICS exists and actually is growing. So regardless of how anyone feels about what's going on, it's not like Russia is all of a sudden going to be out of the market. They've got a big market potentially in China. It seems like India is kind of in the gray area between the BRICS and the OECD. It seems like they're willing to buy other energy products from Russia. So perhaps they will be willing to buy uranium from Russia. That's possible. Then, of course, Brazil will probably still buy from Russia. We recently saw both Iran and Argentina apply for the BRICS. Neither of those are big nuclear countries, but I don't really know how Putin will be entirely cut out of the nuclear fuel cycle, market, let's say. But for the Western countries, because the bulk of the nuclear reactors operators are in the West, the fact that these Western countries are collaborating around this cause, let's say, looks to be positive for further development of fuel cycle processes in the West. That's going to take some time. It's going to cost a lot of money. I don't think all of this doesn't mean anything for the next couple of years, really, for the uranium thesis. But it does, again, look like further solidification of bifurcation. And the importance of that is that understanding that what we're seeing already happening right now in the Western fuel cycle is likely to continue. So that's, Western enrichers raising the tails assays and overfeeding their centrifuges. So that's, I know we've talked about that in the past. I don't think we have time to get in the weeds on that, but basically it's a lot more uranium demand for the Western enrichers to be operating at 0.25 and signing contracts at 0.3 to 0.35. 0.3 compared to 0.2 in an enrichment contract is 20% more uranium the utility has to buy to feed through the conversion process and give to the enricher. Mm-hmm. And until there's more Western enrichment or the world debifurcates and goes back to utilities buying enrichment from Russia, we're going to remain with these operational and transactional high tails assays, and they possibly could even go higher. So it really juices up the uranium demand. We're looking at, structurally speaking, 180 million pounds roughly of demand in 2023. It's just coming from reactors operations. But that number is based on a tails assay. That's like this key little number that you can tweak in that calculation. So you can say, okay, we've got X amount of gigawatts operating globally. How much uranium demand is that? Well, you have to ask at what tails assay. Mm-hmm. At 0.2, it's this much. At 0.3, it's this much. And with Western enrichers, which is about 40% of the global enrichment market, operating at higher tails assays, signing contracts at higher tails assays, we're looking at a big swing with Western underfeeding gone and Western overfeeding here in these higher tails assays. I mean, we're talking about a 30 plus million pound per year swing from in demand. So it's just huge. And the fact that we see these signs of the bifurcation continuing, it doesn't give me the warm and fuzzies when we're talking about, living in a peaceful world. But from an investment standpoint, what is likely to happen over the next 12 months, I don't see this reversing. Mm-hmm. And so, and potentially beyond that. So it's looking like this market will remain split, and that is going to continue to influence the Western enrichers' tails assays and therefore uranium demand.
Yeah, that structural deficit that exists in this market is something that, we see in a couple different markets, but I want to kind of go back to the idea of these vehicles that are taking physical pounds off the spot market. What do you think is the eventual outcome for the market with these players taking these pounds out of the supply? Is it possible that they could be looked at negatively if or when that supply shortage really materializes?
It's, I suppose that's possible. Although the supply shortage materializing, I mean, you could argue that that's happening now. But I think really what you're asking is if we're at, $150 uranium and utilities are like, hey, there's literally no more uranium left. I need some pounds, and Sprott's sitting on, 62 million pounds right now. But maybe at that point it'll be 70 or 80, whatever it might be. Mm-hmm. So for Sprott to be able to sell pounds, that would have to go to a shareholder vote. Like I mentioned, the Zuri vehicle can sell pounds when they have redemptions from their investors. Yellowcake, I'm not really sure about that one. But who knows? I mean, it might be possible if Sprott goes to a shareholder vote that they can actually enter into contracts and sell uranium through contracts rather than dumping it on the spot market. So I don't think the eventual outcome is the funds dumping the pounds onto the spot market. That is what happened in the previous cycle. But those pounds largely were held by individual hedge funds, not by UPC. So the individual hedge funds obviously were making a speculative bet on a commodity, trying to ride it up, trying to time the top and get out. And a lot of them didn't necessarily time the bottom or the top, but they certainly led to the price falling. But some important historical context is, although the price did go from, what was that, $134 a pound at the peak in 2007 down to just below $50 a pound. It hit that, let's see, in early 2009 or late 2008. So in about 12 to 14 months, the price went from 134 back down to 50. That's a big decline, but it held at 50 and it moved sideways for a number of months, making a substantially higher low. So if you recall, before that bull cycle, the low was below $10 a pound. So it went on this crazy spike, settled back to a higher low, which, by the way, at the time, that's following the GFC. We had still a very bullish outlook for nuclear going into 2009, going into 2010. Then the price started to recover. We got back up. I think it was pushing 70. Yeah, $70 a pound from 50 to 70 in the course of about a year. The Chinese were building a lot still. There was still a lot of bullish momentum for nuclear and uranium at the time. And then, of course, Fukushima Daiichi accident. So that was a demand destruction event that caused the bear market that we just went through. But it's really hard to say what will happen to those pounds eventually. If you ask Sprott directly, they'll tell you they're never going to sell the pounds. So I think speculating on a government agency dictating what they must do with uranium, it's just far too speculative for me to even say. But for now, there's enough uranium still, future production, for utilities to contract. And the fact that we have a structural deficit in real time at a certain snapshot, of 2023 of 25 to 35 million pounds, depending on how you look at it, that can only exist because of inventories. So utilities hold inventories and they have to draw them down. And if there's abundant above ground mobile supply, which right now there is not, which is why we're seeing utilities come to the table in such big volume.
Justin, one of the other points I wanted to hit with you is maybe how you see the changing of public opinion towards nuclear. We talked about that G7 meeting. Germany was absent from that meeting. They recently shut down their last nuclear reactors. And as you said, they have a very carbon intensive grid now with the amount of coal that they're burning. I spoke with Doomberg, for example, at the end of February about a particular example near you in California of the Diablo Canyon reactor. The state wanted to get it, I believe it was the license extended for it to remain running. At that time, the NRC had kind of blocked it, and there's more developments with that. But, overall, because you've been paying attention to the space for quite some time, do you see this public opinion shifting in a positive direction? Not only, let's say, in the West in general, and maybe we can include parts of Europe in that, obviously Poland being a good example of that, but even within the US.
It definitely seems like opinions are shifting largely to positive support for nuclear, generally speaking. I mean, there's kind of anecdotal evidence of that just in my own daily life. Went to watch some live music the other night and ran into somebody I hadn't run into for a couple of years. And I told him what I was doing, and he was like, "Oh, wow, that's really interesting." And then he shared something about nuclear energy. He's like, I think he was actually talking about Diablo Canyon being extended. He's like, "Oh, it really is a very reliable, clean source of energy." It's like, well, wow. Like I had that conversation didn't exist 2 or 3 years ago. And that's just one that happens to me quite often actually now, where the reaction is almost universally positive, kind of intrigued, but positive. And Diablo Canyon is one great example. California is very left-leaning politically, and historically the political left has not been all that supportive of nuclear. So the fact that, we have basically a Democratic supermajority in the state, and the fact that it was pushed through and in support by Governor Gavin Newsom, I'd like to think that he has completely shifted and is super pro-nuclear. I have a feeling he's acting more selfishly, looking at a presidential bid, not wanting to send energy prices skyrocketing in the state that he's governing. But either way, the results are to be celebrated. So the NRC actually did approve that extension. They approved that back in March. The last little hurdle that PG&E that operates Diablo Canyon is facing has to do with a lawsuit, which is interestingly enough being filed by Friends of the Earth. Now, I don't know if you've yet seen Nuclear Now, the film by Oliver Stone that was just released a few weeks ago. But one thing that the film does very well is it goes into a pretty deep and thorough history of the anti-nuclear movement. So what they discuss in the film, which was interesting, and I did not know this, so this was very intriguing to me. The Sierra Club, back in the early days of nuclear, so we're talking about the 50s and 60s, was pro-nuclear. They were pro the atom, and they were against hydro. And I was like, oh my God, I love that, because that's exactly where I sit. I care less about the carbon and more about the overall environmental impact of energy resources, and hydro is absolutely devastating. So, but on that note, they were against hydro. They were pro-nuclear. So, and I'm going to mess up the actual date, but I think it was in the late 60s or early 70s, where the person who was leading the Sierra Club, who was pro-nuclear, was approached by fossil fuel lobbyists, was cut a check for $200,000, which in the late 60s, what is that? There's multiple millions of dollars, right? In today's money. He started Friends of the Earth, his own, nonprofit NGO. And Friends of the Earth, since then and to this day, is anti-nuclear. He switched his positioning because he was bought by fossil fuel lobbyists. And so Friends of the Earth still exists today. They're still anti-nuclear, and they're suing PG&E because they're saying that Diablo Canyon, that PG&E is violating their contractual obligations to shut down the reactor. I don't think it's going to work. I don't think they're going to win. They've got the political support to keep it going in California. They've got the support from the NRC, and they're actually out in the market looking for fuel. So they expect to be operating 2025 to 2030 at least, and they're buying the fuel to do so. But that anti-nuclear movement history was fascinating. I mean, it's worth seeing the film just to see that, because it really tells you the power of narrative. And a lot of this big movement in the 70s, happened after 3 Mile Island, and 3 Mile Island resulted in 0 injury or death, period. It was a meltdown, but that was contained with the design of the containment structure around the core. But either way, the fears around nuclear at the time with the Cold War and just everything was like, people really grasped onto that fear, and that pushed this narrative. And the narrative was powerful enough to kind of slow down the development of nuclear, which was going at a very fast pace at the time. So with all of that said, prior to the shutdown of Germany's last 3 reactors last month, polling in the country was showing that majority was in support of keeping them online. So not necessarily supportive of nuclear overall, but at least a recognition of where the country is at in terms of its energy pricing, in terms of its actual grid, in terms of clean energy. So they were actually in support of it, but the Greens stuck to their promise of shutting it down, and truly, unfortunately, they did. I'd mentioned multiple times, I think the silver lining with this is that we have a perfect example of a country that has spent hundreds of billions of dollars expanding renewables and shutting down their nuclear fleet. And what are the results? Because the results don't lie, right? The numbers don't lie. What are the results? One of the dirtiest grids in Europe, some of the highest energy costs in Europe, period. That's what you get. That's what you get if you go down this road. And Germany is a great example of that. But overall sentiment seems to be improving, generally speaking, around nuclear. The Japanese are majority in support of nuclear. The United States is very much majority in support of nuclear. It continues to move in that direction.
It's really unfortunate to have to, as a country, learn that lesson in that way. But hopefully those lessons are learned by other countries, and that example is set. I remember speaking with Mark Nelson about 10 months ago, and he brought up that point of the fossil fuel lobbyists rallying against nuclear. And it's just such a crazy point that you don't normally think of, but it's just insane to think about how these things develop over time and who ends up being the cheerleader for these different sides.
Yeah, it's very interesting, and Mark's done some great work. Love Mark. I honestly wouldn't be surprised to see fossil fuel companies actually potentially engage with nuclear rather than pushing against it. Even though the shutdown of nuclear is always a benefit for the fossil fuel companies, I think that they are understanding at this point the push towards clean energy. And they are also understanding that basically every country on the planet is trying to electrify everything. Mm-hmm. So I think they see where most governments are going in terms of these carbon neutrality goals or these net zero goals, looking out 2040, 2050. They seem to be serious about those goals, at least in theory. Waiting to see the rubber meet the road in some countries like the United States, that's pushing for an additional 200 gigawatts of nuclear by 2040. But that means we've got to get these things started in the next 5 years in order to be able to hit that goal. So we'll see if they can do it. And the NRC is possibly standing in the way. Hopefully not. But either way, I think that they see not only just the rising price environment for the commodity and potentially looking at possible, acquisitions of miners. I mean, we heard the CEO of Occidental Petroleum speak positively about nuclear in I think it was the Q1 conference call that just happened last month. So we could see some sort of collaboration in the future between fossil fuel companies and the growth of nuclear on some level. I see that as entirely possible because obviously the fossil fuels at some point are going to be a limited resource, and these companies are going to want to expand into what they can grow into. So I see that as being a real possibility for, the decades ahead.
Excellent, Justin. Well, there's seemingly a lot of very positive developments here in the space, and hopefully we can have you back soon to keep us updated on those. Of course, a lot of your newsletter and your material is available at uraniuminsider.com and at Uranium Insider on Twitter as well. Is there anything else you'd like to touch on before we wrap up here?
Honestly, there's so much to talk about, but I think we covered kind of the near-term basics here. Yeah, it does really feel like a point of inflection here, especially with the physical market. And that's really, we focus a lot on the physical market with the newsletter, and we do monthly webinar interviews, and the last 3 interviews that we've done have been with folks in the industry that deal with the physical market. So that was Dustin Garrow of Nuclear Fuel Associates, Bram Vander Elst from Curzon Uranium, who's also involved with the Zuri Invest Fund, and Per Jander from WMC Energy, who's a commodities trader, but also does the buying of uranium for Sprott. And we've had very in-depth conversations with these folks, and you have to understand the physical market in order to have conviction sufficient to hang on in this volatile market, or purchase when the shares are in the gutter, which they were last month. We're kind of moving sideways, and these sideways markets, I think, in some ways are more difficult than markets going down, just because they bore people. People get bored. And that's just the reality. The equities are watching a different movie for the time being. But I've seen this before many times. So this is not new by any means whatsoever. So I think it's not that long out into the future where we see some point of inflection in the physical market, especially in the spot market. And with these long-term contracting volumes, it's the downside risk for the commodity here is basically zero. It's basically zero. My confidence is very, very high in the price moving up, and potentially dramatically so.
Excellent, Justin. Well, we'll keep in touch and keep on top of this. Thanks so much for your time today.
My pleasure. Always good to see you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.